After a hike of 25 rupees per litre in diesel prices for bulk buyers over the weekend, the government raised petrol and diesel prices by 80 paise a litre each. Domestic cooking gas or LPG prices were increased by 50 rupees per cylinder, ending over 4.5-month election-related hiatus in rate revision amid rising crude oil prices. The government had kept the prices of auto fuels unchanged since November 2021, despite Russia's war with Ukraine that pushed crude oil prices to a 14-year high of over $140 a barrel. Retail prices of petrol and diesel had been frozen since October 2021, when crude oil prices were hovering around $80 a barrel. Analysts expected a steeper hike in petrol and diesel prices around March 10, when the outcome of the assembly polls across 5 key states of Uttar Pradesh, Punjab, Uttarakhand, Goa and Manipur was announced. G. Chokalingam of Economics Research, for instance, said hiking bulk prices for diesel is comparatively less inflationary than hiking retail prices of petrol and diesel.
Market was expecting a much higher dose across the board, so therefore this is not a concern for the market. The more concern is, the Ukraine and the oil price.
Let's now go to Ambarish Baliga, an independent market analyst, to understand how he has interpreted the development and its likely impact on the markets.
The increase in bulk diesel prices by 25 rupees is clearly an indication of the gap which the oil marketing companies have been absorbing in the last few weeks and could not pass it on for political reasons. Even now, the retail prices have remained stable. This would mean more of the unorganized as well as the lower end of the bulk buyers shifting to retail pumps to buy diesel, whereas the large organized players would be at a disadvantage, buying the fuel at about 25% more expensive. This would lead to increase in transportation costs. Among the bulk buyers are railways, state and city transport corporations, as well as the large integrated logistics players. It would be inflationary as private players will pass on the increase in cost to consumers, whereas government bodies may absorb the same for some time. It's only a question of time when the retail prices move up, unless there's a sharp decline in crude prices in the next few weeks, which doesn't seem probable now.
Analysts believe inflation will trend higher amid rise in oil prices, as the solution to the ongoing geopolitical crisis is not in sight yet. Sonal Verma of Nomura expects retail inflation to average 6.3% year-on-year in 2022, with core inflation likely to trend above 6.5% throughout most of the year. A.K. Prabhakar of IDBI Capital 2 believes that the markets have not yet fully priced in the impact of a hike in fuel prices and its impact on inflation. Let's listen in to what he said.
For the fuel price increase. But there is a hope that, as we are getting crude from Russia, now we are getting very good discount on that crude. But one more factor which we need to understand, now only two companies can refine that low-grade oil. Now one is Reliance and the other is Essar, which is again owned by a Russian company. Now they have the capacity, it gives the refining cost is slightly higher there. And Indian Oil or HPCL, which is now taking the crude from Russia, doesn't have that kind of refinery, so there is a higher cost involvement. So even the discount will get slightly neutralized. It will not be the full benefit. So we have not factored in. If we factor in the fuel prices 10 to 12 rupees hike, now I think market can correct another 8 to 10%. Yes, sir. I don't think market is pricing in full fuel price hike.
With no major economic releases in India during the week, the markets are likely to remain range-bound. Stock-specific action will continue.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.